Welcome to Talk Tickers, the show that cuts through the noise of earnings calls to bring you the sharpest insights.
Glad to be here.
Today, we're diving deep into Medallion Financial Corp Q2 2025 earnings. And what's really fascinating here is that on paper, Medallion delivered a truly standout quarter.
Oh, yeah. A massive beat, surging growth in some key areas.
Right. Yet the market's initial reaction was surprisingly, well, muted, sort of quiet.
A bit flat, yeah.
So the big question we're going to try and unravel today is Wall Street missing a crucial piece of the Medallion story here? Or are there maybe some underlying concerns that aren't immediately obvious? We're here to try and uncover the truth for you.
It's a great setup because the numbers, they do tell a compelling story on their own, but the nuance of why the market reacted the way it did and, what that means for the future, that's where the real value lies, I think.
Absolutely. So let's jump right into what Medallion Financial actually announced. They reported GAAP EPS, that's generally accepted accounting principles earnings per share, for those keeping score of $0.46.
46 cents.
Yeah. Which is a significant beat, coming in like a whopping 43% above analyst estimates of around $0.32.
Wow.
That's not just a beat, that's really a knockout.
Yeah, it really is. And that robust performance wasn't just, a one-off thing. It was largely driven by a substantial 56% year-over-year increase in net income. That reached $11.1 million.
56% jump.
Big jump. And their net interest income, or NII, also saw a very healthy rise. That was up 7% year over year, hitting $53.4 million. So these figures really underscore the underlying strength in their operations.
And what's particularly noteworthy for a finance company, especially now, is that their net interest margin, or NIM, on net loans held remarkably steady at 8.42%.
Very stable.
In this environment, just maintaining that kind of margin is no small feat.
Definitely not.
And total originations for the quarter were an impressive $375.0 million. But here's the kicker. A record $168.6 million of that came from their strategic partner program. Now, that number really caught my eye.
It should, yeah, because that strategic partner program is, well, it's kind of a game changer we'll definitely need to unpack later.
For sure.
Overall, the company's loan portfolio expanded by a solid 4% year over year, reaching $2.49 billion.
Okay.
And for shareholders, Medallion declared a quarterly dividend of $0.12 per share for Q3 2025. That marks a notable 20% increase year over year.
20% dividend hike. Nice.
Yeah. And alongside that, they repurchased $500,000 worth of shares. So clearly they're focused on returning capital to you, the shareholders.
Okay, so mostly strong headline numbers. But on the credit side, the provision for credit losses did increase slightly. It went to $21.6 million, up from $18.6 million a year ago.
Right, a bit of an uptick there.
And we also saw the allowance for credit losses, the ACL, specifically on recreation loans, rise to 5.05%. So this is a point we'll definitely need to dissect carefully.
Agreed. Got to watch the credit.
All right, let's unpack these numbers then and what management was saying on the call, because there's a lot of depth here that explains why those initial headlines are so compelling, but maybe also what the market might be focusing on instead.
Okay.
The loan portfolio itself grew to $2.49 billion. And diving into the segments, recreation loans, well, they continued to be the largest piece at $1.55 billion.
So the core.
Yeah, that's like 62% of their total loans. And it generated a significant $51.1 million in interest income just this quarter.
And if we look at the diversification, home improvement loans represent a strong 32% of the portfolio.
Yeah.
That's about $803.5 million.
Okay.
And then commercial loans rounded out at $121.4 million.
Okay.
Now, it's worth noting that while core consumer lending originations, so that's the recreation and home improvement stuff, were actually down year over year to $197.0 million.
Down.
Yeah, but management explained this was because they tightened up their underwriting standards and were managing capital carefully. And they expect this segment to pick back up now that they've recently raised some capital, which kind of implies this was a choice, not necessarily a weakness in demand.
Right, a deliberate pullback maybe. Okay,
Yeah.
That makes sense. Now, here's where we see Medallion really innovating, I think. That strategic partner program you mentioned.
Yeah, this thing is booming.
Originations here just exploded to a record $168.6 million. That's a massive leap from just $24.3 million a year ago.
Huge jump.
This isn't just growth, it feels like a strategic pivot, doesn't it? Medallion seems to be leveraging its unique funding model to tap into these high-yield, diversified loan segments outside its traditional business.
Exactly. And what's particularly fascinating about these partnerships is the actual business model. So Medallion funds loans from various fintech partners, right? And they often charge an origination fee, maybe 20 to 50 basis points.
Okay, standard enough.
But the real kicker is the holding period. It's typically very short, maybe just 5 days. And during that short time, they earn interest at really high yields, around 20%.
20% yield for 5 days. Wow.
Yeah. And these aren't your typical long-term rec loans. They're often in areas like, say, employee benefits financing or medical procedure financing. Different risk profile.
Interesting. So diversifying away from just RVs and boats.
Right. And while they contributed about $1.2 million in fees and interest this quarter, which isn't massive, yet it's a significant income diversifier. And it has potential for substantial scale. Management expects to add new partners, too.
So it's a powerful new engine for their profitability, potentially.
I think so, yeah. Definitely one to watch.
Absolutely. It really stands out. But of course, with any lending business, we always have to look under the hood at credit quality. Can't ignore that.
Never.
So with all this expansion and these unique new programs, what's the picture looking like on the credit side? Are there any red flags we should be aware of? As we mentioned, the provision for credit losses was $21.6 million. That's up year over year, but actually down a bit from Q1 2025.
Right, sequentially down.
And the ACL on recreation loans increased to 5.05%. So what's the story there?
Okay, so that ACL increase on rec loans, management attributed it primarily to, well, expected seasonal factors and just broader economic dynamics, standard stuff.
Okay.
But they also addressed the uptick in the actual recreation loan delinquencies. Those were 0.49% for 90-plus days past due.
Almost 0.5%.
Yeah. But critically, they primarily attributed this to older loan vintages, meaning loans originated before mid-2023. That's prior to when they significantly tightened up their underwriting standards.
Okay, so management is pointing the finger at older loans, stuff originated before they got stricter. That sounds logical, but is that a fully comforting explanation? Or could it be masking broader underlying pressures that might eventually hit even their newer, supposedly higher FICO originations?
That's a fair question, absolutely. Their confidence really comes from the significantly improved performance they say they're seeing from the newer originations. These now boast average FICO scores of 687 for recreation.
Okay.
And an impressive 781 for home improvement loans.
Much higher on home improvement.
Yeah. So they're basically saying, look at our new book, it's much cleaner. And in stark contrast, the home improvement loan delinquencies, they remained quite benign at just 0.16%.
Wow, big difference.
Huge difference. Shows a strong split in credit performance across their core consumer segments. So the market will definitely be watching closely to see if those newer rec loan vintages truly hold up as promised.
Proof is in the pudding, right?
Absolutely. Needs to play out. Okay, moving on to another key income stream. The commercial segment. This is primarily Medallion Capital. It continues to be an important ancillary earnings engine for them.
Yeah, it keeps contributing.
It generated $3.3 million in income this quarter just from equity gains. And that adds up, it's contributed a substantial total of $27.6 million over the past 8 quarters.
Consistent performer there. And the portfolio itself grew to $121.4 million with a strong average interest rate too, 13.43%.
Solid returns.
And talk about de-risking. Remember when a medallion was almost synonymous with New York taxi medallions? Oh yeah, that was their whole identity for a while.
Exactly. Well, they've dramatically shrunk that legacy headache down to just $5.9 million.
Wow, tiny now.
It's less than 0.3% of their total assets. Yeah. It's almost like they finally sold off that, vintage car that was just taking up space in the garage.
Yeah, good analogy.
And even at this minimal size, they actually managed to collect $2.3 million in cash this quarter from it. And they still see recovery opportunities from loans they'd previously charged off in this segment. It just shows a very deliberate effort to clean up that balance sheet.
Definitely sounds like closing a chapter. A great way to put it. Okay, so from a capital allocation perspective then, Medallion seems clearly committed to shareholder returns.
Very much so.
Beyond the increased dividend and the share repurchases we mentioned, they significantly boosted their capital base back in May. They raised $77.5 million through a public offering of non-cumulative perpetual preferred stock.
Ah, yes. The MBNKO ticker.
Right, MBNKO. And this provides ample capital for future growth, reinforcing their ability to scale these initiatives without straining current resources.
And they're not just growing the loan book, they're investing internally too. The company is also putting money into technological initiatives, things to enhance its consumer loan servicing platform, like developing self-service tools for borrowers.
Modernizing the back office?
Exactly. Now, these efforts are expected to keep operating costs, which total $21.5 million this quarter, maybe a bit elevated in the near term. But the long-term goal is obviously improved customer experience and greater efficiency down the road.
Makes sense. Necessary investment for sustainable growth.
For sure.
So what does this all mean for their outlook then? Medallion didn't give specific numeric guidance, did they?
No hard numbers.
But they did reiterate a clear focus on, and I quote, continued loan growth, disciplined credit, and capital return. Pretty standard stuff, but clear priorities. They anticipate an increased pace of originations and loan growth, targeting maybe a high single-digit long-term average growth rate. And they expect that NIM, the net interest margin, to kind of hover around 8% in the near term.
Which is strong.
Yeah, with potential expansion if, and it's an if, interest rates eventually fall. So that all sounds quite positive, doesn't it? But does it really address the market's initial hesitation we talked about at the start?
That's the crux of our initial puzzle, isn't it? And what's truly fascinating here, and maybe underappreciated, is Medallion Financial's unique funding structure. It's a bit unusual.
How so?
Well, through Medallion Bank, they hold a rare industrial bank charter, an ILC.
Ah, the ILC charter. Not many of those around.
Exactly. This allows them to take FDIC-insured deposits. That gives them a low-cost, dependable funding source that many other specialty finance companies just don't have access to.
Big advantage on cost of funds.
Huge. Additionally, Medallion Capital's unique SBIC status, that's a small business investment company license, is also key here.
Right, the SBIC license.
This allows them to access SBA debentures. Those are essentially low-cost, government-backed loans. And this provides them with a permanent capital base for making longer-term investments, like in their commercial loan portfolio.
So it's like a double advantage on funding, deposits and SBA leverage.
Pretty much. This dual structure is a significant competitive advantage in how they fund their operations compared to peers.
And those structural advantages provide a real competitive edge in what is, let's face it, a normalizing U.S. consumer finance industry right now. Stable net interest margins are absolutely key.
Critical.
Medallion's shares have actually demonstrated strong trailing returns, despite the recent muted reaction. They're up nearly 45% over the past year.
That's right.
Significantly outperforming the broader financial sector ETF, XLF. So it's not like they've been completely ignored by the market.
Exactly. Which makes that modest, though positive reaction to the Q2 results, opening 3% higher but closing up just 1.1% on the call day even more interesting. It suggests investors are carefully weighing those very strong positive growth catalysts.
Like the partner program, the equity gains.
Right, particularly that rapidly scaling fintech origination pipeline and the ancillary earnings from equity co-investments. Weighing all that against the backdrop of, normalizing consumer credit trends, especially those recreation loans we talked about.
So it's really a tale of two narratives playing out. Strong growth potential versus this perceived credit risk in one key segment.
I think that sums it up well, yeah.
Okay. Looking ahead then, key catalysts for Medallion Financial, it feels like it'll be the continued run rate of originations from that strategic partner channel. Can they keep that momentum going?
Definitely number one to watch.
Then further equity gain realizations from their commercial segment. Can they keep pulling rabbits out of that hat?
Consistent contributions there would help.
And of course, the pace of their dividend actions and share buybacks. Continued shareholder returns.
Always popular. Yeah. Sustained proof of strong partner economics when showing those deals are really profitable and stable loss content in the rec portfolio. That could certainly lead to a further re-rating of the stock.
Yeah, it's really about proving out the story in the coming quarters, isn't it? Execution is key now.
Absolutely.
All right, you've heard the numbers, the commentary, the context. Given Medallion Financial's robust Q2 beat, that surging strategic partner channel, and the impressive 8% IM, here's a thought experiment. Our not financial advice segment where we pitch a potentially outrageous but plausible trade idea based on the call.
Okay, let's hear it.
My pitch. Long MFIN equity, coupled with a tactical short of an RV boat-focused asset-backed security, or ABS tranche.
Ooh, interesting pair trade. Long the company, short related debt.
Exactly. Here's the rationale. The core MFIN business, as we've discussed, seems to be firing on all cylinders. You've got strong loan growth potential, consistent equity gains, disciplined capital returns.
All the positives we covered.
Right. And management has been pretty transparent, you could argue, about the impact of those older recreation loan vintages on the current delinquencies. But they're also really emphasizing the significantly improved performance of the newer, higher credit quality originations.
The new book is cleaner argument.
Precisely. This suggests there might be a potential mispricing of the future credit risk within their own recreation portfolio by the market. So going long, MFIN allows you, the investor, to capture the potential upside from the diversified growth and what seems like astute capital allocation.
Okay, makes sense for the long side. What about the hedge? Why short the ABS?
Right, the hedge. So shorting a mezzanine or perhaps even an equity tranche of an ABS, and specifically one collateralized by older vintage RV and boat loans, maybe from a less disciplined originator than Medallion seems to be now.
So targeting weaker, older collateral specifically.
Exactly. And a tranche, by the way, for anyone unfamiliar, just refers to a slice of a larger debt offering like an ABS. They're often differentiated by risk and return. The mezzanine or equity tranches are typically the riskiest. They absorb losses first before the more senior tranches get hit.
Got it. Higher risk, higher potential return or loss.
Right. This provides a direct hedge against a broader deterioration in that specific subsector, older rec vehicle credit. So if broader macro conditions worsen and cause delinquencies to spike universally across all RV boat loans,
Your MFIN long might take a hit.
it might feel some pressure, yeah. But the ABS short, focused on those weaker, older tranches, would likely generate significant alpha. That's, excess return above what you'd expect for the risk taken, because those tranches would likely take the first and potentially biggest hits.
So you're betting specifically on Medallion's underwriting improvements relative to the broader market for that older debt.
Exactly. It's a way to bet on Medallion's specific credit underwriting improvements and their overall competitive edge, which arguably the broader, more commoditized ABS market might not yet fully reflect, especially for those older vintages.
Interesting. Definitely a more complex trade, but the logic follows from our discussion. Okay, so to recap our deep dive today, Medallion Financial delivered a strong Q2 2025, marked by an impressive EPS beat, that significant growth in strategic partner originations, and a clear commitment to capital returns.
Yep. The story here really is one of a company successfully diversifying its income streams and prudently managing its balance sheet, especially that legacy stuff.
While those recreation loan delinquencies are definitely something to watch, they are being actively managed and, importantly, prudently provisioned for. So the overall picture is one of a carefully managed specialty finance company successfully expanding its diverse income streams.
Management remains focused on continued growth, disciplined credit, and robust shareholder value. It will certainly be interesting to see if the market starts to fully appreciate these nuances, especially that partner program, in the coming quarters.
Indeed. As always, please remember that this deep dive provides commentary for informational purposes only. It should definitely not be considered financial advice.
That's right. We strongly encourage you to conduct your own due diligence and consult with a qualified financial professional before making any investment decisions based on anything you hear here.
Absolutely. Do your own homework.
We appreciate your time and interest in these deep dives. If you do have any specific questions or insights about the company itself, Medallion Financial's investor relations team would likely be happy to hear from you.
They usually are.
Thank you for tuning in to Talk Tickers, and have a great rest of your day.